The central bank crisis playbook, rates, bailouts, and the money printer central banks are supposed to be boring. They're supposed to sit above the noise, adjust a few dials, and keep the machine stable. But every few decades, the machine stops responding. And in that moment, central banks are forced to do something that looks like a contradiction: raise rates and rescue the system at the same time, tighten and bail out, fight inflation, and prevent collapse. This is the central bank crisis playbook: rates, bailouts, and the money printer. Not as ideology, not as a political argument, as a mechanism, because once you understand the playbook, you start seeing the same sequence repeat across different crises, different decades, and different headlines. First, the warning signs, then the rate shock, then the accident, then the bailout, then the explanation, then, if the damage is big enough, the printer, and the public is left staring at the same unsettling question. If money can be created in a crisis, what was scarcity the rest of the time? That question is where trust begins to fracture. So let's start at the beginning. A central bank has only a few real tools. It can change the price of money. It can change the availability of money. And it can change expectations about the future price and availability of money. That's it. Everything else is a variation of those three. When inflation rises, the playbook begins with the clean old school move: raise rates, make borrowing more expensive, cool demand, slow the economy enough that pricing power weakens. This is the hard medicine phase. It's not subtle and it's not painless. But if inflation is the threat, higher rates are the prescription. Now, here's the problem. Modern economies are built on credit. Households use it, businesses use it, governments use it, markets are priced around it. So when rates rise quickly, stress doesn't appear everywhere at once. It concentrates where leverage is high and cash flows are fragile. And that's when the second phase begins. Something breaks. Not necessarily because rates are too high, because the system was structured around rates being low. So the first break is rarely the thing you see on television. The first break is often hidden in balance sheets: a bank with duration risk, a fund with leverage, a company with refinancing risk, a sector whose demand depends on cheap loans. Then, suddenly, a word returns to the front of the story: liquidity. Liquidity is not wealth. Liquidity is not value. Liquidity is the ability to meet obligations on time without selling assets at a discount. And in a crisis, liquidity becomes more important than almost anything else, because solvent institutions can still fail if they can't get cash when they need it. That's where central banks step in. And that's where the playbook becomes confusing to the public, because the central bank that just raised rates to fight inflation now needs to inject liquidity to prevent the system from freezing. So you get the paradox: tight money and emergency money. And this is where the crisis playbook truly begins. Step 1, rates rise to fight inflation. Step 2, markets reprice risk. Step 3, a weak point snaps. Step 4, confidence drops. Step 5, liquidity evaporates. Step 6, the central bank provides back. The headlines call it a bailout, but in the central bank's language, it's something else. Stability operations, because the central bank is not trying to rescue a particular institution out of kindness. It's trying to stop a chain reaction. A chain reaction looks like this: one institution fails, counterparties panic, funding markets tighten, asset prices fall, more institutions become distressed, credit stops flowing, the real economy gets hit. So a bailout is often designed less to save the first domino and more to stop the second and third domino from falling. This is why crisis interventions often feel unfair. They are not designed for fairness. They are designed for containment. Now bring in the money printer. Most people imagine money printing as a physical act, paper rolling off a machine. But in modern systems, the printer is a set of digital balance sheet moves. The central bank buys assets. It creates reserves. It expands its balance sheet. And by doing that, it injects liquidity into a system that is starving for it. This can happen for two main reasons. One, to stabilize markets, to keep credit flowing. And in practice, those two often merge because in a credit-based economy, markets and credit are not separate. They are connected pipes. So if a central bank is fighting inflation with higher rates, but it also needs to keep the pipes from breaking, it uses a split playbook. Rates stay high to restrain demand. Emergency liquidity prevents forced selling and funding collapses. This is the part people often call contradiction. But the central bank sees it as a trade-off. We can't let inflation run, and we can't let the system implode. So we do both. Now pausieri, because this is where the story becomes useful. If you're watching the world and wondering why nothing makes sense, it's because you're watching two battles happening at once. The inflation battle and the stability battle. And in crisis periods, the stability battle often wins in the short run because a collapse is immediate. Inflation is a slow burn. So the crisis playbook often becomes talk tough on inflation, but move fast on stability. Now, before we go deeper, if you like documentaries that explain the hidden mechanics behind money, markets, and power, subscribe now. This channel is built for long-form, system-level stories like this, because the next part is where we map the playbook precisely. Rates, bailouts, printer, and the conditions that trigger each stage. Let's define the three stages in plain language. Stage 1, the rate regime. This is where the central bank tries to restore price stability. It raises rates, it signals higher for longer, it tightens financial conditions. The goal is to slow demand enough that inflation pressure fades. In this stage, the central bank's main fear is credibility, because if people believe inflation will persist, inflation becomes self-reinforcing. Wages chase prices. Prices chase costs. Expectations rise. Long-term rates rise. So the central bank needs the public to believe it will do what it takes. That belief is a weapon. Stage 2, the rescue regime. This begins when tighter conditions reveal hidden fragility. A bank run, a funding squeeze, a sudden collapse in market liquidity, a credit spread blowout, a major institution wobbling. This is where the central bank switches from cool demand to keep the pipes open. It creates facilities. It extends emergency lending. It accepts collateral. It provides backstop liquidity, not to stimulate, to prevent panic. Stage 3, the printer regime. This is the most extreme. It occurs when the system's demand for safe assets and liquidity becomes so intense that normal measures aren't enough. When markets are dysfunctional, when credit is freezing, when the economy is sliding into a deep contraction, then the central bank expands its balance sheet aggressively. It buys bonds or other assets. It creates reserves. It floods the system with liquidity. This is what most people mean by money printing. It can stabilize markets, but it also creates a second problem. It changes incentives. Because if markets learn that the central bank will always intervene, risk-taking returns, leverage returns, fragility returns, and the cycle repeats. That's why the crisis playbook doesn't just solve crises. It also shapes the next crisis. Now here's the key insight. Central banks don't choose bailouts because they love them. They choose bailouts because modern systems are so interconnected. Not letting a failure cascade can destroy the real economy. But every bailout creates a memory, and memories change behavior. So the system begins to rely on the backstop, which means that when the backstop is not used, panic becomes faster. This is how policy creates reflexes. Now, let's put this into a simple sequence you can watch in real time. When a central bank raises rates aggressively, watch for 3 stress indicators. 1, funding stress. Are institutions struggling to roll short-term funding? 2, duration stress. Are losses appearing in long-dated assets as yields rise? 3, credit stress. Are spreads widening, meaning lenders demand higher compensation for risk? If those 3 remain contained, the central bank can keep rates high. If one begins to spike, the rescue regime gets closer. And if they spike at once, the printer regime becomes plausible. Now, a comment question, quick and practical. When you are a central bank crisis, what do you think is the most dangerous trigger? Funding, stress, duration losses, or credit spreads? Comment one phrase, funding, duration, or spreads. and tell me why. Now let's address the emotional core of this topic. Why does the public react so strongly to bailouts and money printing? Because it feels like the rules change. In normal times, people are told money is tight. Budgets matter. That has limits. Rates are at the cost of reality. In crises, people watch trillions appear in the system to stabilize markets, and it creates a suspicion. If the system can do this, is money real? The answer is uncomfortable. Money is real because trust is real. Money is a contract the public agrees to honor, and central banking is the management of that contract under stress. That's why central banks care so much about credibility, because once credibility breaks, you don't just get inflation. You get instabilities, capital flight, currency weakness, a rush into hard assets, political blowback. So the central bank is always balancing two kinds of trust. Trust that prices will remain stable and trust that the system will remain functional. Rates protect the first, bailouts protect the second. The printer is the emergency tool that protects both temporarily at the cost of future risk. Now let's talk about the hidden part of bailouts. Most bailouts are not a bag of money handed to a bank. They are a liquidity guarantee, a promise. If you have good collateral, we will lend to you. If the market won't fund you, we will. This is why central banks build facilities, because in a panic, the difference between fine and failed can be one day of funding. So the central bank becomes the lender of last resort. But here's the trade-off. To be lender of last resort, the central bank has to accept collateral. And when it accepts collateral broadly, it is essentially saying, we will turn your assets into liquidity, which again raises the moral hazard question. Does that encourage risk-taking? Yes. Over time, it can. That's why regulation is supposed to prevent the buildup of fragility before rates rise. But regulation is political. And politics is slow. Crisis is fast. So in practice, the central bank often arrives as the only actor fast enough to stop panic. That's why the crisis playbook exists. Now let's make the documentary even more concrete. Imagine three groups in a high-rate environment: borrowers, banks, the government. Borrowers feel higher rates immediately. Mortgage payments rise for new buyers. Credit card rates rise. Auto loans rise. Business loans rise. Banks feel higher rates through asset loans earn more over time, but bond portfolios lose value when yields rise. And if depositors demand higher yields, banks' funding costs increase. That compresses margins. If it happens fast, it creates stress. The government feels higher rates through interest expense. Refinancing debt at higher yields increases budget pressure. This can force fiscal choices. So high rates stress the private sector and the public sector simultaneously. That's why the higher for longer regime is so consequential. It is not just about inflation, it is about how the entire system is financed. Now, the bailout question: when does a central bank step in when stress in one part threatens to spread into the whole? And the fastest spreading mechanism in finance is panic. Panic travels through depositors, counterparties, short-term funding markets, asset liquidation. So central banks step in where panic spreads fast, not where pain is morally deserved, where contagion is most likely. That's why the playbook often looks unfair, because the goal is not justice. The goal is to stop a fire, and in a fire, the first priority is containment. Now, a second comment question: do you think bailouts are mostly about saving institutions or about preventing contagion? Comment: institutions are contagion. And your reason in one sentence. Now we move to the printer. The printer is not the first tool. It is the tool used when stability operations aren't enough, when markets are not functioning, when buyers disappear, when spreads blow out, when even safe assets trade irrationally because everyone is selling everything for cash. That is the true printer moment. The central bank becomes the buyer of last resort. It buys to restore market function. It buys to stabilize the benchmark, yields the entire system prices off, and by buying, it injects liquidity. But again, the trade-off. The printer can also inflate asset prices. It can widen inequality perceptions. It can encourage future leverage. It can make the system more dependent on central bank support. So the crisis playbook carries a hidden cost. It can keep the system alive while making the next crisis more likely. Now, here's the line that ties everything together. In modern economies, central banks have become the managers of two fears: the fear of inflation and the fear of collapse. Rates address inflation, bailouts address collapse, and the printer is the bridge between the two, a temporary solution that buys time. But time is not free. Time accumulates consequences, which is why every crisis intervention creates the next debate. Should the central bank have done less, or should it have acted sooner? Now, let's land this documentary with a practical watch list. If you want to see which stage of the playbook we're in, watch these indicators. 1. Inflation trend and expectations. If inflation is sticky and expectations rise, rate pressure stays. 2. Bank funding and deposit behavior. If depositors move fast, rescue pressure rises. 3. Credit spreads and liquidity. If spreads widen sharply and liquidity dries up, the printer becomes plausible. 4. Political tolerance. Because in the real world, a central bank doesn't operate in a vacuum. Its independence is real until it's tested. And the test happens when unemployment rises, markets fall, and the public demands relief. Now, the last comment prompt to make it specific. Which tool do you think creates the biggest long-term risk? High rates, bailouts, or money printing? Comment one phrase: rates, bailouts, or printer, and tell me what you think breaks later because of it. Now, the final thought: central banks are not wizards. They can't create oil. They can't build factories. They can't legislate productivity. They can only manage money and confidence. And in a crisis, confidence is the scarce resource. That's why the playbook looks the way it does. Rates to defend credibility, bailouts to defend stability, printer to prevent collapse. And the real story is not whether the playbook is good or bad. The real story is what it reveals: that modern economies run on trust and leverage. And when trust is damaged, leverage becomes dangerous. So if you want to understand the next decade, don't watch the headlines. Watch the playbook. Because when the pressure rises, the same sequence returns. And when you recognize the sequence early, you stop being surprised by the decisions that follow. If you want more documentaries like this, subscribe. Next, we'll map the next layer: how liquidity actually moves repo markets, collateral, and the hidden plumbing that decides whether a crisis stays local or becomes global. Until then, keep watching the system, not just the speeches.